Are we on all the chats yet? We're just gonna check.
Should be. Don't worry. You guys do this,
Okay, we
and I will handle
do
it
what
all.
we gotta do. Okay. Good day, guys. I've just flew back today. I'm back in Singapore, so there's a room change. And yes, it's a smaller place, duh. And yeah, today I have a very good friend of mine. So finally, I'm bringing some guests, right? Some Singaporeans to share with you, what's going on in the Singapore market and just kind of bump ideas and just kind of get to learn from each other and see where we can go from here. So of course, Chung
Sure.
is with us today. And today I have a good friend of mine, Ethan. And he is in the business of trading endowment plans. And what does that mean? Essentially, it means that, if you have a plan that you don't want, like an endowment or life policy that you don't want, and you want to sell back to the company, there's always a surrender value, right? And that is the X amount that you're going to get. But there are traders in this game, in this business, okay, that will pay you a slight little premium. So you're going to get a little bit more on top of that surrender value. And Ethan is right smack in this business. And I got him on the show to share with us a little bit more. How does this work? A little bit more about endowments and what do we watch out for, in this choppy market with our plans, and how do we manage our finances together? So welcome, Ethan. Welcome on the show.
Hi, everyone.
Yes. Hi. Good day. So Chung is busy directing. Let's just continue. So yes, Ethan, could you share with us a little bit more about what you do? I mean, I briefly shared that you traded plans, but just come and do a deep dive with us for people that don't know you, don't know what you do. Yeah, share with us, what do you do?
Okay, maybe I'll start with what I wanted to achieve when I started the company. So
Sure.
basically, I was a financial advisor with AIA in Singapore for 1 year. And of course, when I got this opportunity, I started to talk to clients. And I realized that a lot of people, even my friends and families, close ones, a lot of people, they are paying for endowments. But after 7 or 8 years, they start to think that, hey, why am I paying every month, paying this premium, and I don't know what to do with it? Should I stop it? Should I continue? Should I invest in the market since I know about stock market? Yeah, so this is why I started to think that, hey, why not we understand what is opportunity cost first? So what is opportunity cost? Basically is, let's say for example, I have 5,000 now, and in the case of endowment, it's like every month I need to put maybe $200. So opportunity cost is, let's say I have a product, I use that 5,000, I put it maybe in the stocks, and every month I put in $200 into the stock. Okay, what is the rate of return that I can get from buying the stocks versus the endowments also?
Okay.
So at the end of the endowment, there is this maturity value. So I will pack it to that maturity value. For example, let's say 30,000, and what is the investment rate of return required to achieve that endowment maturity? Then from there, you can make a better informed decision.
Okay, cool. We will discuss a little bit more about opportunity cost as we go along. I know that's a very interesting concept for everyone to learn. But you talk about how people, after a few years, servicing their endowment, then they go into this dilemma, right? So after 7, 8 years, then they'll be like, oh, actually my friend is making more money in the stock market, or my friend bought a property, and all those kind of stuff. Yeah. I'm curious, what do you usually tell them, like all these kind of clients, when they come to you, how do you educate them in this process?
Okay, I need them to understand what is their risk propensity. For example, how much risk that they can take. Okay, because I have different clients from age 20 all the way to age 60, 65, or even 70. So their risk, the ability to take risk and the willingness to take risk, it is very tight together. So let's say for example, you are age 20. Your ability to take risk is very high because you have very long horizon until retirement, correct? Let's say 50 years. So you can take a lot of risk, no problem. But your willingness, are you willing to take the risk or not? That is important point for especially for a lot of people, because I don't want people to like, hey, I'm not willing to take risks, but I bought into the stock market. So for example, now stock market is down 30%. They have a heart attack. They go to the hospital. It becomes my fault already.
Yeah.
So that is willingness. You need to understand yourself already. This is a lot about investment mindset already.
Okay. So it's not all about technicalities, not all about opportunities, right? And you compare it with the stock market. So the stock market on average, right, gives about 10 to 12% year on year, right? Correct me if I'm wrong. If we assuming we never.
Actually, like close to like 8, maybe.
Okay. I was just
Yeah.
about to say if you factor inflation, real growth is about 8%. Okay, so yes, we are aligned. So at about 8%, right? Can you share with us like how does an endowment come into the game? You know, for someone like us, like 2030s, you know, most of my listeners were about this age, right? And if we can get cumulated growth, that means year on year, on average about 8% real growth in the stock market, then where does endowment come into the picture? You know, it feels like a dinosaur, you know, in this financial world. Right?
Actually, before we go deeper into this, for those people who are watching, like, can you explain what an endowment is first, just to make sure everyone's on the same page, everyone has the same understanding, there's no confusion.
For endowment, basically, it's just a regular savings plan.
Okay.
Where you buy from the insurer. It's just a plan that is a regular savings plan, which behind the endowment there is a basket of funds which the insurer invests for you, and they give you the returns from there for you.
Yeah.
So they're taking on the risk. Yes, they're taking on the risk by giving you lower returns.
Okay, so it's usually, can you, because, you know, I guess coming from Canada as well, like there's many ways of doing something like that, right? So in most endowments in Singapore, is it usually like a guaranteed return for a set period of time, or is it like, you know, however the stock market goes minus 2%, or but like, you know, if it's a negative year, then it's a zero, like, so there's a floor to how much you can lose.
Okay, for Singapore endowments, they have this, we call it the smoothing of bonuses. So for example, for the past 8 years, the market have been doing well. So they actually take part of it, put it in a reserve ratio, like a bank like that. They just put it reserve at a side, so that during like years like now, they take the bonus from there, put it back and give it to you. So they actually smooth the return. So typically is from the benefit illustration, the a lot of numbers, details that they want. Okay, they talk about 3.25% and 4.75%. So typically for us, we just take a middle ground of 4%. So it should achieve for IRR itself about 2%.
Okay.
What is
term?
Okay, what is IRI?
IRR is the internal rate of return. So it's basically, to put it in a layman's sense, for example, I put a fixed D for 10 years. So every year is giving me 2%.
Okay.
And with endowment plans, there's also like usually a term limit, right? So most of them are 30 years. Is that correct?
Most of them, okay, there are 25 to even very short-term one, 10 years. Okay, and there is also a special breed of, they call it short-term endowment plans, which is typically 3 to 5 years. So it depends on what you're looking at.
So in other words, it's almost like a forced savings in the sense that you have to pay it every single month. But in return, that ideally your return will be higher than just putting in the bank, right?
Yes. That is the product feature if you look at it.
Okay, thank you. So carry on.
Yeah, okay, wait. Let me go further down that. So, what is the difference between endowment and savings plan then? Because I keep hearing these terms in the market, right? So I just kind of want to clear up, you know, what is the difference?
Savings plan can be anything, actually, if you ask me. Because to me, when I talk about savings plan, basically it's a plan that helps you to save. That's all. So it can be done via endowment, can be done via regular stock purchasing, can be done even just putting into a bank account, for example. But
Okay.
endowment is actually a special product that is by the insurer that they actually invest for you. So that is the only difference to me.
Okay, fair. So then when people, because in Singapore there's always this long-term savings plan,
Yes.
what does that mean then? Just kind of curious.
Long-term savings plan, as the name suggests, is a very long-term one
Okay, and
before
it is
you actually take money out.
okay, but it is kind of like an endowment in that sense.
Yes.
Okay, so does that mean that they also invest for the client?
Uh, Most of the long-term savings plans they do.
Okay, okay, that's cool. Yeah. So then when clients come to you, right?
Yes.
Usually at what time of this? Because from what I understand is that if it's a 25 years, there'll be a certain time when you actually are making profit already. Like that means
Mm.
if it surrenders at a certain time value, there's already a profit, right? So
Mm.
typically at what time period does your clients kind of connect with you? And what are some of the main reasons that they decide to drop this
Wow.
endowment plans?
Okay, for most of the clients that we buy over the plans from, either they started, okay, it's a range lah. Maybe I'll start with the youngsters, those in the 20s to 30s. Okay, because they just got the endowment plan, for example, 1 to 2 years. Then after that, they got exposed to the stock market. So they start to do a comparison. Like
Mm.
I see stock market is possible to get 8 to 10% returns, but the endowment is just giving me like at most 2.53%. Am I missing out a lot or not? They'll be asking.
Oh,
Definitely.
okay.
Yeah.
And for the
Yeah.
older
So
clients?
for the older clients are more of like because they are reaching they are in their 50s. Okay, if for older clients I can still stay into midlife and nearing to retirement. For the midlife one is because most of them are PMETs, professionals, managers, or even they are having a midlife crisis. So they are faced with a lot of job change, uh, finances, increment of their financial needs, all that. So they are the ones who also say that, hey, I'm actually paying so much into my endowment, so can I stop it or not? They want to know whether they can stop it and what is the opportunity cost. For the retirement one, is more of like, because they are nearing their retirement, endowment is going to end soon. So you just want to see, is there a better product that I can actually take out the money and just put it in for their retirement. So these are actually the characteristics of different groups of people.
Cool. So given that, right, where do you
Yes.
see endowment as a tool then for people? Like like just now we want to talk a little bit about this, right? Like
Mm.
where is endowment then, to meet the kind of needs for us? What tool does this serve?
I would say it's just a behavioral way to start saving, if you ask me. Okay, because there are many ways to achieve your financial goals. It depends on the products that you use. So endowment is just a product, and I don't like to talk about products though. But okay, we talk about products. Endowment itself is basically just a savings plan whereby maybe at the end of 25 years, 20 years, or 15 years, you need that money. You really need that money for a number of goals. It could be paying for down payment of property. It could be for your children's education, which is a lot of people has been so into that idea also. It can also be just a short term one. Maybe you just want to put your money at somewhere better than the bank because you don't know a lot about financial products. So it really depends on your level of savingness and also the kind of guarantee that you want at the end of 25, 20, or 15 years.
Okay. You use the word guarantee. Who is
Yes.
guaranteeing this thing?
Okay, for this it is not 100% guarantee, but
Yeah.
if we
Because
talk about
Singaporeans very sensitive about guarantee. You
Yes.
say guarantee, you better guarantee, right? So let's talk a little bit about that, right?
Okay, so for endowments, okay, the way how endowments work is, let's say for example, out of this amount of, let's say this amount of the maturity value, right? At the start of the first year, endowment will be give you this guarantee. Every year it just stacks up until at the end of 25 years, you start to see that amount of guarantee that was given to you lah down here. Okay, but it can drop a bit, like maybe up to 80%. So it's between this range. Yeah. So that is the kind of guarantee that we're talking about. So let's say, for example, if we put an arbitrary amount of 50,000, right? So people will tell you to save about 55,000, so that at least if let's say the endowment really do very badly, it will give at least 48,000, for example. Just an arbitrary number.
Okay, so this is not a contractual guarantee of any sort, right? That states when you put this money in, your guaranteed minimum return or guaranteed final value of this policy will be X, 50,000 or anything like that, right?
It depends on the policy itself also, because different insurers, they structure the way the endowment works differently. But if we talk about generally, when you say you want 50,000 at the end, most, in fact, all should be able to give you that 50,000.
Okay.
Hmm.
Yeah, because I guess we're primarily talking about endowment policies. Does it change when it comes to life insurance? Because life insurance there's a guarantee, right? Like upon death benefits.
Yes, correct. So for endowment, actually, it's the same. It's just that, okay, when we look at endowment and life policies, right, you just think of endowment as 99% savings, 1% insurance. But for life policy, it could be 20% insurance, 80% savings. So you can see that the more savings you put into, the higher the returns will be, correct? Because you pay less for insurance.
Yeah.
So whole life policies actually works in a way that they try to match inflation only every year. And if you look at past 20 years whole life policies, every year the yield will be about, depending on your age. If you are very young, it can go up to 6%. 6% per year yield. But if you are already very old, like 55, the yield per year will be 3 or even 2%. It can even go up to 1% only when you're at age 70, because that is the time when they think that, okay, you are going to go to heaven. Because the typical life expectancy is 85.
Yeah.
So the closer you are to 85, they expect that the death benefit will be given up. Yeah. So that is how they work that plans in as for actuaries.
Yeah.
So actuaries are basically people who calculate how much money they need to set aside for the plan.
Okay.
So there's a lot of mathematical, statistical that goes into all these plans before they can sell you and make a profit.
Definitely. And then how do you make a profit? Like when people come to you, all right, like how do you guys make money, and what is the benefit of selling to you rather than just surrender?
Okay,
Where are you in this game? Right.
can I skirt this? Can I not answer this? Okay.
Come on, man. Everyone is tuning in just to hear the juicy news of how this business works, right? And you cannot skip this, lah. Cannot.
Okay. Basically, okay, we look at the number of premiums paid into the plan already. So let's say for 10 years, you already paid 1,000. So at the end of 10 years, you already paid 10,000, for example, for a 25 years policy. But now the surrender value only gives you maybe 6,000, let's say, for example. So when we buy over, it's up to 10%, right? So it's 6,006, for example. So the premiums that you paid to the insurer, where does it go now? It doesn't just disappear, right? So that is actually the margin that we're looking at.
Oh.
But of course, for the premiums that is paid, that 10,000, right, we also need to buffer in a guarantee for our investors. So normally we'll just take less than that. So our margins will reduce based on how much guarantee that we give to our investors.
Okay. So
So
if
all these are inside the document already.
okay. So essentially when I surrender there is a X value, and then
Yes.
if instead of surrendering I sell it to you guys, which are like endowment traders, then
Yes.
you will pay me a little bit more, which is in your case about 10%.
Yes.
10%.
Up to 10%.
Okay, up to 10% of the surrender value additional.
Yes.
Okay. Then you will sell it to someone, right?
Yes.
And who are these people that you sell it to? Because your margin's quite thick, huh?
It's not really thick lah. If you put in the marketing cost, the manpower cost, the investor guarantee cost, yeah, it's actually not a lot depending on the policies.
Fair.
Yeah,
Okay.
but let's say normally we work with fund managers, family office, accredited investors, and in fact our course trainees. For example, if we are giving free courses, free seminars for them, so they actually have a chance to participate in our plans. But actually, we love financial professionals actually because they understand what we are talking about. General retail investors, they do not understand, so they need really a lot of education on the risk, on the how I can guarantee it, why I can say that, what makes you so sure that I can give you that investment return or that if I sell the policy to you. Yeah.
So I guess just to clarify then, you prefer working with accredited investors overall or accredited individuals because they already have the right knowledge. So then from your side, there's less hand holding, right? It's more like, okay, let's just talk the actual business side of things. But that doesn't mean you could still technically sell it to like a retail person. Like, if I wanted to buy the policy off you could sell it to me still, right? There is no issue there.
Yes. There is no issue there, but we prefer to work with people that we know.
Yeah.
Yeah. Especially financial professionals, because they understand the terms we use, and we really they require zero hand holding actually. Because for accredited investors, right, they have their relationship manager, they have their financial advisors who service them, correct? So for any claims that is required for such a special traded endowment plans, they can just get someone to do it for them. And for financial professionals, for example, financial advisors, because they are in the business, they know how to do claims, they know what to look out for, they know what to submit to the insurer, then there is nothing for me to educate them also because they are doing the job.
Yeah.
Fair. So then is this only in Singapore? Because I think we have some Malaysian audience, right? Like can they sell you their plans, or how does that work?
We can try because okay, what I'm thinking now is forex risk. So for example, if I get a Singaporean to buy a Malaysian plan, what if Malaysia ringgit drops? Then my Singapore client lose money,
Mm,
right? Or if let's say the Malaysian client who buy a Singapore policy, Singapore the Sing value depreciates a lot, then they lose money also. So I would rather not deal with forex risk in this case. So if I were to deal with a Malaysian, I would want to sell the policy to a Malaysian. That's number one. Number two is I need to understand Malaysians endowment plans also, because the regulatory requirements, basically the law is different from Singapore. So I need to study before I take in Malaysian policies, but that is a possibility still.
Look up or look forward to it.
yeah.
So we actually have a question if you guys don't mind.
Sure.
So this popped up just now. So I'll just read it out loud here. Quick question. If I assign my policy to someone else who buys over it, let's say the person has no other sources of income or is sick of paying for my crap and can't sell it back to you guys for some reason, would it be accurate to suggest that person has an incentive to kill me for the death benefits? Thanks, Money Maverick.
Well,
Yeah.
if you have to ask that way, definitely that is called moral risk. Basically, what he showed is basically a moral risk where people will want to queue for the death benefit. So why we have this company in place is so that we can minimize the, let's say for example, policyholder. So the policyholder sells to us, so we know the policyholder, but the investor doesn't know the policyholder. So at least there is a barrier over here.
Okay, so the investor really just buys, or so I guess how does that work then from an investor perspective? Because I guess do they have to trust you that the policy that they're buying is exactly as you stated? Like how can you withhold?
Definitely not, because once we buy over the policy, we are the policy owner, so we do have all the details of the policy. So from there, we show the details of the policy to the investor and tell them how do we get all the investment returns, how do we get the figures, how does it relate to the endowment, and then they just buy over. And I have to emphasize on this, when we sell the policies, right? When I talk to investors, I only tell them what is the maturity value. We are not supposed to be talking about death benefit.
Okay.
That is really a bonus. A misfortune or once that it becomes your benefit, which I don't want to touch on.
Okay. So there's no way for you to replace that person's name with your company's name first, right? And then pass it on or anything like that, right? Because the policy was written for this person. So technically it's still under their name. You just own it.
Okay. If you have to look at insurance contract, right? Okay. There are actually 4 people involved. So one is the policyholder, one is the payer, third one is the beneficiary, and the fourth one is actually the person, the life insured. So normally in an insurance contract, all 4 will be the same, because it doesn't make sense that if I buy a critical illness policy, I'm not the policy owner. I don't pay for the policy. I don't benefit from the policy, but I'm the life insured. Isn't it very funny, right? Okay, so going back to this 4, right? Okay, the last person, life insured, is actually the basis of the contract. So this cannot change. So the life insured can never change. But the 3 person in the front, the owner, the payer, and the beneficiary, it can change.
Okay.
That is how we do the change of the names.
Yeah. So when just walking through it, we're using your 4 people or the 4 people involved. So the owner won't change.
The life insured. Yes.
The life insured person will not change.
Yes.
So what they are actually doing is they're changing the person paying to you, or to you,
Yes.
essentially to you at that point. They are changing the beneficiary to you, and they are changing what's the last one?
Payer of the premiums, the one who pays the policy.
Okay, yeah. So they change all of that to you, right? And then what you're doing is you're essentially taking these 3 pieces and you're selling that option to the institutional investor.
Yes.
Okay.
Interesting. Won't they ultimately find out the guy because of the contract?
They will definitely find out, but the thing is, it is very difficult to find a person if you just know the name and NRIC, because the address, all that will actually not be in the database anymore. So that is also why I say I would prefer investors to just look at the maturity value, because in the event that the life insured pass away, it will be very difficult to trace also, if you ask me. Yes.
Okay. Can I just clarify that? Is this like a gray business, or is it not regulated, or where are we in this?
Okay, in Singapore, it is considered not regulated. the exact details I can't be sure why it is unregulated, but I can only say that probably because there are not a lot of people engaged or involved in this, especially retail investors, where in Singapore the law is meant to protect. The MAS would want to protect retail investors more, basically. So as long as we don't deal with too much retail investors, it is unlikely that it will be regulated unless there is a push by the industry to have it regulated by MAS.
For those who don't know what is MAS, Monetary Authority of Singapore, is like Bank Negara. Okay, yeah, that's kind of where Central Bank of Singapore. Yeah. So are you seeing like an uptick in your business given this COVID-19 situation?
Definitely. But we have a lot of people approaching us saying that, okay, I have an endowment, I have a whole life policy, I want to sell it to us. So that is how the business works, I have to say. But of course, for us, we want them to be educated to understand what are their other options, because selling to us before surrendering is always the last option that we will want them to take.
Oh, okay. Can
Because
you share with us
okay,
what are these other options then?
okay, when you have the policy, there are a few options you can do. One is make it a paid up capital policy, which means that the policy will have a reduced sum assured or reduced benefit, but you no longer have to pay the premiums anymore. So that is considered like upfront payment of the policy and wait for it to mature. Okay. The other way is you still want to continue with the savings plan, but because your cash flow is just tight, for example, for that 1 year, for a very short term, then you can take a policy loan at about 5.75% to 6%. So which means essentially you're taking a loan from the insurer based on your policy. Then after that 1 year, you will pay back the principal and the interest. So it does make sense because if you take a personal loan outside, is the effective interest rate is about 10%, 12%. Your credit card bills are 24%. So you wouldn't want to touch that. You would want to touch the lowest interest, which is your policy loan, for example, for this case. So, but if let's say you have credit card debts and you didn't manage it well, giving out and selling the endowment plan would be a much better choice if you look at it in that way. Yeah.
Okay, interesting. I don't really have a plan. Like I don't have an endowment plan, so I don't know much. But yes, Chung, does it work in Canada? Is it the same?
Similar. So I have a life insurance plan. And I mean, I bought this plan specifically to, so there's what was the concept called? I forgot what it was, but it was essentially the idea of you get the lowest, what you were saying, right? Like trying find the policy that can give you the lowest
Interest rate.
insurance and then, or insurance expense, and then the highest savings that can be used to purchase more of it, right? So it's actually growing internally for you, and then being able to use that as a loan to essentially, so that essentially you have money on both sides, right? Because the whole idea there is like, even though you take out a loan, like yes, you pay that interest, but internally because you still own the whole policy, you're still getting paid the interest in that policy, right? And if you structure it correctly, then it's a way to, it's just a way for you to like have money, like essentially it's a savings fund that grows, and regardless of how you use it, and the way and that's why I say, Reggie, when I talk to you about how I still have about like another 20,000-30,000 in Canada, like most of that's in this policy, right? And that's when, like, once the market hits that bottom, that's when I'll be like, okay, I'm going to take out that 20-30, put it in, ride it up, and then pay it back, so that I'm not being charged that interest anymore. But at the same time, that policy is still growing internally for me to take advantage of future opportunities.
Which is a very smart way because your money is still growing.
Yeah. And the thing is, because it's also, I mean, in Canada anyway, 'cause 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 it's the money growing inside the policy is tax-free, right? Whereas as soon as you take, and in Canada, when you take money out for investing purposes, it's tax deductible. So my interest rate, even though it might be stated at 6%, taking my interest tax bracket, I might actually be paying an effective like 3%, and then my plan might be giving me 4 or 5%, right? So I'm actually making money doing that.
Oh, yeah. That is a very, very smart way to do things. But I think that only works for the Canada, because in Singapore, a lot of our capital gains and a lot of our dividends are actually non-taxable.
Yeah.
So that is why in Singapore, nobody likes these plans.
Yeah. So there's not as much value. I mean, that said, even when I was trying to look it up in Canada, most people really didn't understand it, right? Because it's a very complex thing of like, how do you have money in two different places? How does tax rates work? And then the big pain point a lot of people have when it comes to insurance policies is your first, 2-3 years or payments is essentially paying for your agent's fees, right?
Yes.
And they're like, oh, that's always their biggest sticking point, and they don't get past that to talk about the benefits.
Dang, you get tax deductible for investing.
Yeah, because it's technically just a loan, right? I'm taking a loan out too. So that becomes something I can just write off as tax, or for tax deductions. So the ultimate scenario for me would be to take, have this grow big enough for me to use it as a down payment for a rental property, and then get the bank to pay for the rest, so that everything I have in that property is completely tax deductible, which really lowers that rate. And then of course, once that property appreciates, or I pay off a part of it, then I have more money I could potentially use in the future, right?
Wow, good stuff. If I ever shift to Canada, I know who to call.
The US is huge with this type of thing. The US, their deals are way better. And like, I know Warren Buffett, like, I don't know if he still does it anymore through one of his holding companies. But I know he does a lot of this, what we're talking about here, right? Like, he buys people's insurance policies, and he will hold them to maturity because he has that money. And so for him, it's almost like a guaranteed return, like a guaranteed savings rate, right? Because right now he's, why would he hold 180 billion in cash when he can potentially hold 100 billion in some of these policies that he can potentially, get out of anytime he wants, and convert that to cash to buy investments, right?
Yeah.
Anyway,
yes. You want to say something?
With this space.
Cool shit, man. That's cool. And yes, I think we always talk about endowment being one of those tools, and then there's like the equity market, where we are very active in. We talk a lot about this, and we don't just talk. We're dipping our toes in this thing, right? So, do you engage in any kind of investment tools other than just endowments yourself?
You mean my personal investments?
Yeah. Any? I mean, I'm trying to drive towards giving some advice to like young people, right? So, yeah, just kind of curious where you are.
Yeah.
Okay, for people in my position, because we are founder, we are startup. Most of our cash will be in our business. So, so previously I did investments in stocks and shares. But it's really about how much you know that you can make investment in the stock market. Because, for example, if you invested in Singapore, High-Flux or Noble, you are losing near to 90 to 100% of your money already. So stocks and shares, they do have that kind of a risk, but that is very rare as long as you diversify. So for the average investor, just diversify. The easiest is just to buy IWDA. It's actually a ticket. IWDA, I'm not sure whether you guys are familiar with. It's
London. Singapore? Oh, it's London. Okay.
Yes, London domiciled exchange traded world fund.
Okay,
iShares in everything, every shit that you can diversify.
Okay.
Yeah, so it's actually the easiest.
Are their fees very low, or?
Their fees are one of the lowest, and for Singaporeans, the withholding tax is only 15% instead of 30% for dividends. Yeah. And for capital gains, for Singaporeans, there is no capital gains tax also. So it works perfectly like a savings plan.
Okay, that's some juice. Wait, let me see the ticker. IWDA, MSCI World Shares.
Yes. So it
Okay,
just diversifies across the world, emerging markets, developed markets, everything.
sounds good. So you just buy one thing and then everything's settled.
Yes.
So that's your best advice for people starting out.
Yeah. I would say that's what Warren Buffett would want people to do also. Because you just invest in an index which invests in majority of the big market capital, basically big companies which can almost never fail. Yeah, so that is actually the best advice for the average investor. But of course, if you are very good, you will be talking about value investing. What is the PB ratio? What is the PE ratio? What is the free cash flow? What is everything? So that will be very technical. So I wouldn't want to go into that aspect until at least you are very savvy with your investments already.
Yeah. So going back to your business, what skills if someone wanted to explore this as potentially a side hustle or something, what skills do they need to really master before they can actually start dipping their toes and doing stuff like what you're doing here?
Oh, okay. You need to understand insurance contract inside out. Really, that's the number one criteria because you are dealing with a contract.
Yeah.
And you need to understand what are the important things to look out for. For example, the benefit illustration, where they have this column of guaranteed and the non-guaranteed, and where is actually all the bonuses coming in. Where is your best yield? Because in order to you need to know that so that you can advise your investors, right? If not, your investor asks you this question, you know what is the internal rate of return, where is the best time to surrender, or when is the best time to take the money out. How can you refinance it with maybe the banks by taking premium financing, basically similarly to how people use their property to leverage, which in a fully paid property they reverse mortgage. So for policies, you can also sort of do reverse mortgage with the bank and leverage the money when you need it. For example, when you need to buy stocks and shares. So these are the things that you need to understand to add value to your investors.
Okay.
That is the first thing. The second thing will be capital. Basically, you need at least 50,000 to jumpstart a lot of things because you need to buy over insurance policies. You need to ensure that the plans are paid, the premiums, how much you can leverage on all this. So 50,000 would be definitely a start.
Yeah. And I guess for those people, let's say that's way too much for them right now, but they might be interested in making some extra cash on the side right now, and they know people who have endowment policies or life insurance policies that may be looking at saying, oh, you know what, I don't really want this anymore. How can they make some extra money? I.e., how do they refer things to you?
Oh, okay. Okay. For us, for each successful case that we take over the policy, we will give $100 as a referral fee to the person. And if the policy is very attractive, we'll give up to $500. So it's between 100 to 500 for each successful case.
Yeah.
Yeah,
Perfect.
for
So,
referral.
in other words, I guess if they know anyone who have policies that those people might are debating whether or not to just sell off, they can just go onto your web or your Facebook page, which we've actually linked in our description, and contact you guys to have a conversation. Right?
Sure, definitely.
That's
Cool.
cool. Cool. Anyway, so I mean, we keep talking about the upside, right? All the good stuff. But what is the risk on your end? Like when you are doing something like that, you know, what kind of risk do you bear as a company or as an individual trying to trade endowments?
Okay, for us, number one is trust. I would say the risk is trust, because whatever we sell, we have to ensure that whatever is inside the contract is what we speak to the investor. So if we don't understand the contract, that's why I bring up the point where you really need to understand the contract in order to do this business. Yeah. So that is one of the risks. The second risk is we do have some investors who ask us whether they can guarantee them a minimum amount. For example, like 2.5% minimum. But because the policy itself, the guaranteed portion is only 2.2%. So if we give that 0.3% guarantee, right, as a company, we also need to reduce their returns really in that case. Yeah.
Okay, okay. So then, given such a choppy environment today, right? Uh,
Yes.
where do you see your business growing? Like you as a founder, you as a startup, what are your plans going forward?
Oh, okay. For us, we are actually looking at making a one-stop place for financial planning, for financial, basically to understand finances. But I have to say this: we are not under the FAA in Singapore, which is the Financial Advisors Act. I think in Malaysia, you guys also have a similar one, right? Whereby you must be registered with MAS, then you can give advice and recommendations to people. So we are not, so we cannot give a specific financial advice to say like, okay, you can buy this stock at this price. Yeah. So we can't give that. But what we aim to do is just to inform people what is your opportunity cost basically when you want to give up the plans for that. And for us, uh, we are also working with mortgage dealers. We are also working with financial advisors. We are also working with even funds, which they may have private placement. So we can actually give access to our investors that is not inside the retail market. So we are actually working with other fund managers pushing their products, whereby they are selling like maybe notes, promissory notes or bonds. Yeah. And in the very long future, we might also want to do a unit trust, but that would entice us to have a license to set up a unit trust. So that would be a very long way already. Unless our growth in the next 5 years is like 500 or even 10 or 200,000%, that kind, yeah, then maybe we can start to look at a unique trust, which the underlyings are all these traded endowments.
Ah, interesting. So, how much? What is the license requirement to get a unit trust license?
There's a lot of compliance to do. There's a
Yes.
lot of licensing and uh, in fact accounting, because from what we know, minimum 250,000 just to clear the compliance.
Mm,
There is a fee. Yeah,
yeah.
250,000 fee that you need to clear in order to just get the license and start your unit trust.
So why do you think no one has actually gone down the path of creating unit trusts focused on endowment plans?
Maybe the market is not big enough. Maybe
Okay.
because you need to grow the market before it can become that big, like in the United Kingdom, whereby they have 100 years history of traded endowments.
Okay, so in the UK, they actually have unit trusts or mutual funds or whatever focused on endowments.
Yes.
Oh,
Wow, that's cool. That's
tell us
cool.
more about that. Like, how does that market look? What type, like, because usually with like unit trusts, people are usually looking at it from like an investment perspective, right? What type of return are they managing? Like, because it's pretty stable with endowments as well, right?
Yes, correct. So typically for those, it's about 4% and above, because they also do life settlement, which means they also look at the death benefit. So their returns can be much higher, because if death occurs, the internal rate of returns can go up to 200 or 300%. I mean, just look at the premiums that you pay, maybe 1,000. When you took over someone else, it's just cash value. But let's say, for example, you pay the premiums of 1,000 for 3 years, that will amount to 3,600, but it gives you additional 50,000 because of the death benefit. So what is the returns already?
Yeah.
3,600 to 50,000 in 3 years. Oh my god, yeah. So that's why the unit trust that actually takes into account the death benefit actually can even make up to 6%, if I'm not wrong, after fees, which means after paying off the fees and everything.
Wow, that is.
So, but that is in the UK lah. That is in the UK.
Yeah, because you almost need to have your whole like your own actuarials to like in house, right? To figure out like what's the expected
Yes.
broad death benefit for each year.
Yes.
Wow. Okay. Yeah. I hope one day we get something like that. But yeah, when you let's go wind back a little about literacy. Like you did talk a little bit about literacy, and I'm super big on financial literacy. I mean, the whole podcast is about financial literacy. So, what are you planning to do in this space, right? Because there's a lot of growth in this space. I'm quite curious what you're trying to do in terms of raising financial literacy.
Okay. But personally for me, I'm actually just a trainer for financial literacy with a training provider in Singapore. I believe Singapore is starting to understand financial literacy. So MOE schools, which means basically the public schools in Singapore, they start to engage providers to teach financial literacy to the children. So what they learn over there is how to manage your money, what are the emergency funds that you require, uh, the different jars that you can put, like play jar, savings jar, charity jar, expenditure jar. So they have this jar concept to teach children to put their money in, so that at least they can easily put the money in, they understand how much they can save, and how to reach their goals that they want. For example, I want to buy maybe a toy that I really like for $30, but every day I'm getting $2 a day. How much I need to save in order to buy that $30 toy? So that is something that we are trying to impart to children nowadays.
Serious? You start kids that young?
So is this a government initiative, or is this like?
No, it's actually enrichment by the schools themselves that they engage. So it's actually like an enrichment class. But increasingly, I think the government has a bit more focus on financial literacy. You can see that in the poly, they have this financial literacy. I think it's a group. Yeah, and in SMU, they have also a financial literacy group that is all volunteers under the SMU, Singapore National University. So in the tertiary environment, to me, I think it's quite mature already. It's just for secondary and primary, it's still not so mature.
Yeah.
Oh, are there any such initiatives in Malaysia?
Not that I'm aware of. Yeah, none that I'm aware of in Malaysia or in Canada. So.
Okay,
Wow.
so you're telling me that I should start a financial literacy school in Malaysia.
Well, you can start. It's the question is whether the demand's there, right? Or whether the awareness for financial literacy is there among
Yes,
big enough group of parents that they're willing to put it through. Yeah.
It's
Fair.
okay. I don't mind starting with the affluent first. I believe they will want.
Well, when Reggie comes back to Singapore, come along with him for a while, see if you like it.
Yeah, and then we can chat about it. But yeah, I think that's about it from me. I've gotten quite a lot of juice coming from you, and yeah, I'm pretty happy. Although we have a little bit more time. Any more questions from Chan?
No, nothing on my end. Yeah, so I guess any last words or anything you want people to know about Policywoke, or are you hiring, or are you looking for more business, anything like that?
Okay, for now, we are still looking for collaborations with other family office or fund managers, because for my investors, they are sophisticated enough, they understand leverage, and they want more ways to grow their wealth. So they will be looking at alternative investments, because since my one is alternative investment which we can leverage again, so they will want to leverage some more. Yeah, so that's what they are looking at.
Nice. Yeah, I mean, I would too, right?
Yeah.
Yeah,
Let's all.
The
it's like
fundamentals.
yeah.
Yeah,
So
it takes all, man.
if you look at the Fed's rate currently now is near to zero, right? So if I can leverage my policies at one or 2% and invest it in the stock market now, which I can after that do a share financing from the share itself and start investing some more. I don't know. These are kind of ideas that my accredited investors and my fund managers are looking at. So it's just like basically leverage after leverage after leverage, so that
Yes.
it can increase the returns basically.
Yeah.
Yes.
Well, so long as you're leveraging on something that's pretty stable, right?
Yes,
Yeah.
correct.
This is a whole different ballgame of discussion.
Yeah.
Yeah. I that we can do it privately, right?
I was gonna say we probably leave it privately, but if any of you guys are interested in learning or talking more about like leverage in any sort of way, leave comments wherever you're watching this, and we'll see. I mean, if there's demand, we'll see what we can do. If not, then we'll definitely just keep this private.
Yeah. This complex stuff, right? Yeah.
Yes.
So thanks for coming on the show. I'm very happy that you share all whatever you shared with us, and I hope you do really well in the coming year or two, right? And I'll see you around since I'm back in Singapore after I'm done with my stay home notice of 14 days. Hopefully by then it's not a lockdown, and then we can have coffee.
Sure.
Okay. See ya,
All right.
guys.
See you.
Bye. Take care.